If you had to judge a company's entire performance on just one single number, what would you pick? Well, for a ton of investors, the answer is the net profit margin. It really is the final verdict on a company's health because it cuts through all the noise of big sales figures to tell us what actually matters.
Think about it this way. For every single $100 bill a company brings in through sales, how much is actually left in its pocket after every single bill is paid? That's the simple but incredibly powerful question that the net profit margin answers for us.
All right, so here's our game plan. First, we're going to nail down exactly what this metric is. Then, we'll take a little journey down the income statement to see how it's all calculated. After that, we'll get into the fun stuff. How to read the final number, how to spot the red flags that the pros look for, and finally, how this whole thing is used out in the real world. So why all the hype around just one number? Well, it's because it packs everything in. It reflects a company's pricing strategy, its control over costs, how it handles its debt, and its tax situation. It's all rolled into one single decisive percentage. So in simple terms, the net profit margin tells you what slice of the pie is left after everyone has taken their piece. We're talking suppliers, employees, the landlords, the banks, even the government. Whatever is left over, that's the pure profit. That's the real bottom line. To really get a feel for this, let's follow the money. I want you to imagine a single dollar of revenue starting a long journey. And at each stage of this journey, a little piece of it gets chipped away to pay for different costs. We're going to measure what's left at each and every stop. Now, this journey has 3 key checkpoints. First up is gross profit, which basically tells us if the product itself is even profitable to make. Then we get to operating profit, which shows if the day-to-day business operations are efficient. And finally, we arrive at net profit, the end of the line, which shows what's left for the owners after all is said and done. This table here maps out that journey perfectly. We start at the very top with total revenue. From there, we subtract the direct cost of making the stuff, the cost of goods sold. Next, we pull out all the operating expenses. That's everything from marketing and salaries to R&D. Then we've got to pay the interest on any debt the company has. And finally, you know it, Uncle Sam takes his cut through taxes. That number left at the very, very bottom, that's net income. And it's the key ingredient for our margin. Okay, so we've done the math, we've calculated the number. Let's say it's 12%. So, is that good? Is it bad? The answer, as it almost always is in finance, is it depends. But there are some general rules of thumb that can give us a pretty good place to start our analysis. You'll often hear this number, 10%, tossed around. Across a whole bunch of industries, a 10% net profit margin is often seen as a sign of a healthy, stable, and pretty well-run business. It means for every dollar in sales, the company gets to keep 10 cents of pure profit. Let's add a little more color to this. If a company is consistently pulling in margins above 20%, whoa, that signals a company with a serious competitive edge. On the flip side, if it drops below 5%, that could be a red flag that things are getting tough. But here's the most important rule of all. A single number is just a snapshot. What analysts really care about is the trend. Is that margin growing, shrinking, or just holding steady over time? That's where the real story is. And this brings us to maybe the biggest rule in all of financial analysis. You absolutely cannot compare apples and oranges. A 10% margin might be fantastic for a grocery store chain, but it would be a total disaster for a software company. Context, my friends, is everything. Just look at this. A software company might be hitting a 30% margin. And why is that? Well, think about it. After they develop the software, the cost to sell one more copy is practically zero. It's incredibly scalable. But then you have a retailer, maybe they only have a 4% margin. They've got huge inventory costs, fierce competition. They have to rely on massive sales volume to make their money. You have to benchmark against the right peers. All right, time for the pro-level stuff, because smart analysts know that the profit number you see on paper isn't always the whole truth. It can be managed, it can be massaged, and sometimes, well, it's just plain misleading. Let's look at the traps you need to avoid. So, the core issue here is that accounting rules actually allow for choices. It's not always black and white. And those choices, along with some unusual one-time events, can make the net profit margin look way better or way worse than the actual underlying business reality. Okay, here's a classic example. Let's say costs are rising.
If a company uses the FIFO method for their inventory, it makes their costs look lower, which then artificially inflates their profit and their margin. But a company using LIFO in the exact same situation will report lower profits. See what's happening? Same business, different accounting choice, totally different margin.
And it's the exact same story with depreciation. A company can choose to spread the cost of, say, a new factory evenly over time. That makes profits look higher today. Or it could use an accelerated method that front-loads the costs, making profit look lower now but higher down the road. Nothing has changed about the actual cash flow of the business, but it dramatically changes the reported margin. And there are other traps, for sure. A company could sell off a building and get a huge one-time gain that makes the margin look amazing for that 1 year. And please remember this, profit is an accounting concept. It is not the same thing as cash in the bank. A company can report a beautiful high net profit margin and still go bankrupt because it just doesn't have the cash to pay its bills. Okay, so after all of those warnings, you might be wondering, how do the pros actually use this metric? Well, they use it like a diagnostic tool. By comparing it with the other margins we talked about, they can pinpoint exactly where a company is winning or where it's losing. Think of it like a doctor diagnosing a patient. If there's this big drop from gross margin down to operating margin, the problem is somewhere in the core business. Maybe they're spending way too much on marketing or their rent is too high. But if the big drop happens after that, from operating margin down to net margin, then you know the problem is financial. It's probably too much debt or maybe a really high tax bill. This technique lets an analyst find the exact source of the pain. So here's the real bottom line on the bottom line. The net profit margin isn't just a number you pull from a spreadsheet. It's a final grade on management's entire performance, their strategy, their efficiency, their discipline. It's the whole story of the business told in a single percentage. So I'll leave you with this thought. The next time you see a financial headline or glance at a company's earnings report, are you just going to see a percentage? Or will you now be able to look a little deeper, ask the right questions, and see the entire fascinating story that's hiding behind that bottom line?